foremost, directive number one to everybody in the room who's listening to me, I need you all to go to Linda at Linda Raschke on Twitter, because first of all, if you're not following her, you literally are a step behind in the stock market. She just throws out nuggets of gold all day long about what's going on with, what the possible scenarios of how they're going to play themselves out. It's really fun, and she's one of my central follows on Twitter. Of anybody who's even remotely interested in how the day-to-day flows of the markets are going to be. And there's a reason for that. She's been doing this for 40 plus years. She's been doing it for more years than most of you have been alive. So she's got 10 times more experience, and she really has an amazing feel for the day-to-day inner workings of the market, because she's been watching those prices and flows and seeing every single thing you could possibly imagine in her very illustrious career. So that said, I want everybody to follow her. She's also, I will text this link to you. Linda actually runs a trading room with her husband, Damon, who used to be like one of the, top-notch brokers on the Chicago Mercantile Exchange. Great guy, but also I just found out the other day, a rock and roller, which is kind of cool. And the thing is that they're going to run this room only for about 6 more months. Is that correct, Linda? You just said to me that this is
it just came up during the coronavirus, and so now that the world's resumed and people can go outside back to normal, we're ending it at the end of the year.
Correct. Yeah. So it's basically been a labor of love. So if you really want to just get the last of her wisdom, I really recommend you guys join her room, because I'm telling you, in one day you'll probably learn more than you'll learn in a year with somebody else, because she is literally seen every cycle and every market. Those of you who have been living under a rock and don't know who Linda Raschke is, she is one of the great all-time traders, and she's as I'm sure everybody has read Market Wizards at one time or another. She's actually the original Market Wizard. But what's just astounding about her, and I've had a chance to speak to her many times, is she doesn't have to do this. First of all, she likes doing this, but she's been doing this. This is a business that chews people up and throws them out faster than almost any other business I know. So if you can survive this business for 5 years, it's a miracle. If you can do it for a decade, it's really an achievement. If you can do it for 2 decades, it's an unbelievable achievement. And by the way, this is true on any size scale. Name me one hedge fund manager you guys remember from the 2000s that is still alive. Well, there are a few. Let me put it this way. Name me one hedge fund manager that's still alive that's actually making money, which is the secondary component of it. It's very hard. Linda's been making money for 40 years, which is just astounding in this business, in some of the hardest environments possible, which is the intraday trading or the short-term trading, swing trading, where you really need to be able to read price action and be incredibly flexible in both your mindset. But I think the reason for this, and you'll hear her talk about this, I'm sure, is a very common trait that literally every single successful trader who's been at this show has shared with you, which is preparation. I'm going to let her speak to it, and then I'm going to let her show you her setups and just what she does and give you her ideas. But then we'll discuss a little bit about, you need to understand just how much work this lady puts in every single day just to be as good as she is, to truly understand that to succeed in markets, it's not a simple game. You need to really be focused and pay attention. So without much ado, because she's got so much to say, I'm going to give her the screen. Linda, I'm going to give you the screen, make you a presenter, okay? And that we'll be able to watch your computer screen. Make presenter, there we go, yes. And do you have it? Let me know if you have it, and I'll tell you if we start seeing your screen.
Okay, let's see here, show screen.
Yeah, just show your screen. There we go. Trading strategy that served me about 40 years. We see your screen. Beautiful.
You can see my main monitor there.
Yep, we see your main monitor. Yep.
Okay.
All right. I'm going to stay on camera for just a second, just to do this and introduce you. Obviously, everybody knows Linda Raschke. She's the final speaker of our Trader Fest. That means she has the floor for as long as she wants. and I'm not, I'm not going to cut time at all. She can talk as long as she wants. We'll ask her questions afterwards. There'll be plenty of time. So don't freak, and enjoy. And without much ado, I'm going to get off camera and just let her run the show because she's got the truth to tell you. Thank you very much, Linda.
Is it?
Yep, we see your
All
screen.
right, everybody can see my screen. Thank you,
And
Boris, for that effusive introduction there. I don't know what
I'm a
I should
big fan.
say. Can you see everything?
Yes, we see it fine.
Okay. Thank you for hosting the Traders Fest. Thank you for the incredible amount of work that you have put in behind the scenes, organizing this amazing slew of speakers. I would love to meet our previous speaker at some point, Stuart in Australia. And I had a dear friend, Mandy, also speaking from Australia. So even though I'm going to start out my presentation addressing some of the nuances with the US session, I want you to understand, and I'll explain how you can look at these nuances, whether you're trading in Asia or whether you're trading in Europe. So just be patient. It's fairly broad-based. When Boris invited me to speak, he suggested that I present one trading strategy for you. Because we have a limited amount of time and I can't regurgitate everything I would love to regurgitate over the next week solid, which I probably could do, I just concentrated on one subtle nuance that perhaps might make a difference in your trading. And it's along the lines of things that are not necessarily linear oriented from the market structure and the time series data. And when I express that, most of us tend to want to frame the market out with indicators and these linear measurements by which you can capture one data point at a time. But to me, the markets are this living and breathing, organic, dynamic, basically organism, because that's what it is. It's comprised of multiple market participants on all assorted time frames, as well as the overlay of the money flows that can be the main driver. So, what I want to talk about is a little bit more some of the nuances that I operate by that are not necessarily captured by an indicator such as a stochastic or a Bollinger Band or these types of functions. So we always have to show risk disclosure. Yep, part of the protocol. So when I first started trading, I was on the trading floors and particularly the San Francisco Stock Exchange and then the Philadelphia Stock Exchange. And back in the early 80s, we did not have computers. We did not have charting software. We didn't even have the internet, for Pete's sakes. So on the floor, you're operating without the benefit of having this visual representation of the price data at all times. Although a lot of floor traders did keep notes by hand, that's in part where point and figure evolved, as well as the market profile display of the time series data. And so you have a different feel, and most of that feel is based on two things. It's based on the volumes that can come in at certain times of the day. This represents the best of the trading opportunity. And there's also time of day functionality. So what I'm going to talk about is going to be a little bit more oriented towards that day trading time frame. But if you want to step out a time frame and take all these same concepts and apply them to those daily trendiness, you'll see that we also have things such as seasonality, the tendencies and statistical edge that we have around holidays, the statistical edge that we have around end of the month. So you can see that these types of metrics are much different than looking at breakouts from standard deviation functions, or again, back to our traditional oscillators. So everything goes hands in glove. I just want to draw your attention to the edge with a different type of formatting. So when we were on the trading floor, you also start to see some very definitive rhythm to the swings of the day. And that's where we're going to start off here. And I used to keep a little line chart by hand, and I noted that when trading the S&Ps, which actually didn't exist when I first started trading, but they came on board shortly after. And I would notice that there were three main swings during the day, which would last anywhere from 30 minutes to 90 minutes of duration. But that was a choice opportunity if you could just capture one of those swings during the day. So you see already how our minds are starting to think. We're starting to think in terms of pieces, just a piece here or a piece there. And so what we noticed is that the market opens, there's not much information available. So typically the market has to go through a price discovery process. This is part of the auction theory, price discovery, which can be testing in both directions to determine where the buyers and sellers come in and if there's going to be a true trend for the day. So this price discovery process and move off the opening price occurs in the US opening, the Asia opening, and the Europe opening. And let's just, for our purposes, we'll assume that Japan and Hong Kong and Korea, even though they're slightly off by half an hour, are generally the same type of idea. So what happens is that people tend to be more emotional in the morning and they're more likely to chase. And I'm sure that you have noticed this as well. When we were making markets in the equity options, we would call this first 30 minutes of basically a dogpile orgy the opening bulge. And this is often a time where prices are, the trade location can be most disadvantageous. This opening bulge, these first 30 minutes of trading. So then what will happen is you're either going to have at the top of that first 30 minutes that test reject sequence or pause, rotate, and then continuation of the trend, which actually happens a lesser amount of the time. So this early morning check mark, this test reject, can provide excellent risk reward. If you are interested in really seeing a different way of categorizing these things, there's a wonderful book that was written 20 years ago by Jim Dalton, Mind Over Markets, and it will detail out in auction theory terminology these concepts of open drive, which is what we have when we get that proverbial trend day, or open test reject, or open rotate. And if the volume's light, you can have a very neutral type of day. So volume is a component here. But with that said, the open drive lead to a trend day actually is the least likely scenario. So we can start off right there looking for that morning check mark. I'm reticent to trade right around that opening price. And here in the United States, there's this proliferation of small traders trying to trade breakouts off of 1 minute bars or breakouts off of 5 minute bars. So if you look at that data, you will observe that the range for that first 5 minute bar is increasingly greater than it ever has been. And the noise level consequently has increased. So that's a challenge when we're trading, dealing with that early noise. However, after that top of that first 30 minutes, you'll see that this noise level has dissipated and we have a clearer idea of the directional bias of these volume flows. So with that said, this is in the good old days, mind you. We then get our morning trend in either direction off of that. I'm going to use Central Time for all my references of price. We'll tend to get that morning trend off of that 9 a.m. Central Time, and that will last for at least an hour and a half of duration if we are fortunate to be trading on a higher volume day. So that is the sweet spot of the data for me. That's where we can capture some good profits. And then, of course, when Europe closes, Asia's long gone, the Europeans are gone. And of course, I know that the DAX and the Bund still trade, but I'm just saying, the institutional players often, walk it back a little bit at that time of day, and the volumes subside and the morning trend comes to an end. Now, typically it used to be that when trading stocks, the markets were made by the specialists. And so the specialists who had to feed out inventory on that morning rally then would get a chance to get it back on the little bit of reaction that unfolds when the buying subsides. A lot of times when markets go down, it's not always from selling coming in, it's from the buying halting at the top and there's no more buyers around. And so then prices naturally dribble on down. And then, of course, you have your lunchtime consolidation. The volumes are lighter, it can be noisy. And typically around 1 o'clock in the afternoon Central Time, we can see a resumption of the morning trend that would go in the same direction in the afternoon. So this is just one of about 6 variations that we commonly see. But in my mind, I'm looking at these time of day functions and the swings. So sometimes we have seen where we have just a lot of rotation around the opening price on both sides of the opening price for the first hour and a half. And then it's very likely that we could actually get trend in that lunchtime hour. I call that the sneaky lunchtime move when everybody's tuned out for the day. So you can see that there's several variations, but they're pretty common, and that's the way that I organize my day. So just with this time of day functionality. So moving on, you can also say that, this first 30 minutes, the top of the hour, is where we're really going to concentrate with this presentation, and then we'll take it from there. So also an important concept when you're trading is that concept of chunking data, because it's such a sea of sensory overload out there. You can't possibly process for 7 or 8 hours continuous data, continuous price data, volume data, ticks, news, all these different things. And so you'll find that the majority of people will tend to make more profitable trades in the first part of their day and more unforced errors in the second half of the day. And that's because we get tired. On balance, we can only truly give it our best 100% cognitive processing for 90 minutes. After 90 minutes, you should just be aware that you are more prone to sloppy decision making, and it might behoove you to take a break, walk around, step outside, go get some water, etc., and then come back feeling fresh again. So this concept of chunking data also allows our brain to make shortcuts without having to pull up a bunch of charts and so forth. So a good example of chunking data could be correlations between markets. Perhaps you're trading the euro currency and you're noting the same price action in the British pound, or perhaps you're looking at the Canadian dollar and processing that relative to the Aussie dollar. So that's just that correlation moment is another way of chunking data. Time of day is a way of chunking data. Let me just see if there's a trend for this hour. That's a way of chunking data. Watching price relative to another price, such as, for me, the previous day's high and low, is just another little shortcut so that my brain cells do not drown in this sea of choppy waves of constant time series data, flooding past. So all things that are very important. So I'm going to concentrate not only on the movement off of a certain time of a day, but then I'm also going to look at some levels, and we'll touch upon that at the end of the day. So I think that you'll see that I am about as a kiss blonde as you can get, a keep it simple, stupid blonde as you can get. Even though we have spent decades of modeling and doing statistical analysis, the problem is that every other billion-dollar hedge fund with 40 PhDs grinding away on supercomputers and so forth are always digging for that same edge as well. So the experience that you build up with your personal observations, and not all of these things can be modeled and quantified, go a long, long ways. And so for me, I'm perfectly content just to keep my levels focused to horizontal lines. And I loved it when Stuart was showing his slide and he showed a big horizontal line that suggested there was all this congestion activity. And these auction theory market profile concepts lend themselves extremely well to these horizontal lines. So we'll look at some decisions. And lastly, I want to give you one last nugget, okay, that I don't see people really concentrating on, but it's the areas of undeveloped trading. So just to remind you that the same principles I'm going to talk about apply to Asia and to Europe, the volume surges that can come in on the opening. And then we have to ask ourselves, in the spirit of that commercial from several decades ago, is it real or is it Memorex? Okay, and we'll look for these inflection points to evaluate, even with the Europe session, is this trend going to continue or is it going to reverse? So let's look at some actual charts.
Hey, Linda. Linda,
Yes.
hi. Sorry to interrupt you. First of all, I love the is it real, is it Memorex? I bet you there's 3 people out of the 500 that actually understand that metaphor. But if I give you some kind, you're going to charts now. You've been in what's called presenter mode. If you can go to full screen mode, then they could see those charts a lot better. So I just wanted to.
Oh my goodness, I did not realize I was
It's
not
okay,
in
it's fine.
full
It's fine. The
screen mode.
slides were perfect, but now that you're in screen mode, it's going to be a lot easier for them to see full screen mode. I mean, now that you're in chart mode. So I just wanted to tell you that if you can do that.
Am I in full screen mode now?
No, you need to hit that little. I think you need to hit the um where next to the 3 dots. There's the full screen mode, like that computer monitor with a dash inside of it. If you hit that, that should put you into full screen mode, I think.
3 dots. Could you
The-
see any of my previous slides?
Underneath the slide, there's a circle with 3 dots, and then there's a computer monitor with a diagonal dash inside of it. I think that's the full screen mode. See that?
Okay, be patient for 1 sec
No
here.
problem. Take your time. It's fine. We got plenty of time. I just want to make sure they all see the charts really well, so you can show it to them.
Okay, so you could see my previous slides.
Right.
Okay, I see
There
the
you go.
3 dots.
Yeah.
And screen.
I think it's the one next to it, to the left of that. That's that. If you hit that, doesn't that take you into the full screen mode? No, maybe not.
Do you want this screen down here?
I want full screen mode here. Don't end the slideshow. He said go to the 3 dots.
Let me show you something. Wait, which one is your main screen? That is full.
Okay, so on our end it's showing full. Let me hold on.
Maybe they're watching this one.
Oh, you might be watching the little one.
Hang on a second.
Yeah,
Hold
we
on.
see
I
you
got
presenting.
Damon here is my
Oh, there
tech.
you go. You got it. Damon, you're the man. Thank you.
Okay.
Damon, you're the man.
Hello, gang.
All right, thank you so much. Now you
This
fixed it.
is this is my trading buddy during the day. See, I can get befuddled and he can clarify everything. So Damon is my husband, and that's a different story. But we have fun during the day here with these markets. All right, so on to the hardcore data. I'm going to start off just simply showing these two little orange dots here at the left of the chart, where it doesn't appear that much is happening, is the 7 a.m. Central Time reading for if you are in Chicago. And that's the start of my day. I actually come in and start 15 minutes before that, because this also can provide a window of opportunity more pertinent to the financials, the currencies, and gold and silver and the bonds. Part of the reason is, as I mentioned, we are creatures of habit. And in the old days, before the advent of the internet and our digital way of viewing things, the institutional players would sit down at their desks at 8 Eastern time in New York, and then 20 minutes later, the bond pit would open. And that sort of started their day. And we would get other pits opening right at 8 o'clock. So this is still an important punctuation point for that hour and a half of duration before the NYSE stocks open. And of course, you have the release of economic data potentially during this time period as well. So that's extremely important if you are in the currencies and the bonds and so forth. So here, I took all recent data for you, recent charts. So I tried not to cherry pick anything for you. So this should be pretty representational of just some basic trading. And you can see once again these yellow dots. This is CQG, and I can put a little time of day function on it. And I think you can do this with just about any trading software. But for illustration purposes, these yellow dots are the NYSE opening, that first 5-minute bar. And this is the issue I was talking about, how we start to see the magnitude of these bars has increased exponentially in the last couple years. So everybody's trying to jockey for position. Is it going up? Is it going down? And it could be a great way to ruin your day if you start off on the wrong side of things or get caught up in over trading or reactive. You see the can of worms here. But notice this, these purple dots up here are the 9 o'clock reading. And this is the inflection point that has lasted for the past 40 years. It tends to be more prominent when volumes are higher. And of course, on a light volume trading range day, it's really not going to have that same impact. But you can see that we ended up having an open drive. Once you took out the high of that first 5-minute bar, it was not so easy because there was this initial look above and then trade back down. So another problem when we look at charts, we're doing it with hindsight bias, and we may not see all the little noise and problems with uncertainty along the way. So, just like Stuart lectured, doing your own homework and research and analysis, part of that is always studying a strategy on a walk forward basis. Because when we back test as well, the problem with that is that it tends to lump all these different states together. The two states primarily being that trend mode, those trending markets, and it could be on daily time frames such as the currencies, versus these consolidating noise rangy markets, which have a completely different rule set if you want to look at data-driven strategies, such as, is it a mean reversion strategy or trend and trail that stop type of strategy? Those same things apply on the intraday time frame. So here we can tell there's obviously some good volume off of that opening price because there is a 90% correlation between the length of the bar and volume. So I don't need to plot volume on a chart. I can tell you right in here before the opening is extremely light volume, and right in here on this noisy, choppy consolidation is also very light volume. But we can see that the highs of the morning so far were made on this sharp test reject. And you don't have to be, I don't necessarily try to short the top of that bar at that time, but I'm watching the price action, and the fact that it came down so sharply tells us something right there. And then the whole idea is be kind to yourself. I find this the sweet spot of our whole trading day, this morning sweet spot going into Europe close. Europe close came just as we were peeling out down here. And if you are evaluating your trading, what you want to think of is capturing 1/3 of the swing should be your benchmark. If you can capture better than 1/3 of the swing, looking at the length of this swing from high to low, you are a better trader. If you find yourself capturing 1/5 of the swing, you probably are a little bit too nervous. There's nothing wrong with that. As we are starting out in our trading journey, I would rather see people have a shorter holding period just because it helps you practice your execution skills and gain confidence. And then as we have watched the markets for longer and gotten more experience, your confidence level will build in terms of holding for those higher time frames. But your goal is to work on getting at least 1/3 of a swing. Okay, so this is the crux of what we're looking at today, and I want to look at it on several charts and then European markets. Now, here is the flip side of the coin, and this is once again why it is such an important time of day for me. It sets the whole tone for the rest of the day, as well as whether there's going to be exceptional opportunity. And here, once again, we see the opposite. You have your big yellow dots highlighting that 5-minute opening bar. And you can see the same thing on the Europe opening as well. And then we sell off for that first 30 minutes. Another statistic I like to look at is the fact that we never traded above the high of that 5-minute bar. So how the market trades right around that opening price can also offer valuable clues. So in this case, we never traded above the high of the opening price, nor did we trade above the opening of that 5-minute bar. And that also is one of the precursors to leading to a trend day. So here was our 9 o'clock reading. We nary got a reaction back up, and then of course it slams on down, and ultimately the trend had to flush a little bit past that time duration of the Europe close, which comes in at 10:30 Central Time, 11:30 Eastern Time, and sometimes we see it push right into the noon hour time frame, which at that point, the institutions, the mutual funds, all that kind of stuff go to lunch. Okay, this is just a broad, generic model here. So the other thing that you can see is that this green line here is the previous day's high, and the red line is the previous day's low. To me, these are the most visible data points seen by all market participants, be it funds, retail, commercials, it doesn't matter. Everybody sees these same levels, and you can see right away here this lovely play where we gapped above the previous day's high and immediately started selling towards it. And if you've been trading for a while, you'll know that many people like to gun for this closing of the gap type of feeling. And easy to see here how people took profits. The smart traders who shorted the opening took profits on the test of this previous day's high, and then the trend continued until we went all the way down and tested this previous day's low. So far, what I'm talking about, you see, could be just plain candles, no moving averages, no oscillators, just the action around a certain time of day, the action around the opening, and the previous day's high and low. And that's what I really would like to convey to you, is how much we can learn about the market's action and trading without the advent of charts, or let alone indicators. You see, because this is what we did for 10 years on the floor. We didn't have a representation of this data on a bar chart form. Instead, it was all, how is it opening? Where is the volume coming in? What is the trend? And, that previous day's high and low. So this still is a great way to operate today. And let's just look at a few more. Again, our big 5-minute bar never traded above the high of that bar, and then came out the downside, a flush right into the top of that 9 o'clock reading. So again, it's an inflection point. So this inflection point only led to a 30-minute consolidation, which would have had the appearance of a bear flag or a continuation pattern, before once again flushing down into Europe close and ultimately into that noon hour time frame. At that point, when we were on the trading floor and that clock struck 12, it's like Pavlov's dogs. Half the traders would then go and take lunch between 12 to 12:30, and then they would come back to man the pits, and the other half would then go to lunch, between 12:30 and 1. And if it were a particularly slow day, they would sit upstairs and play backgammon. So you can see there's not necessarily much opportunity there in the middle of the day. However, if the volume started to pick up or there was an unusual event, you could trot right back down within 1 minute and be on that trading floor again. So assuming there's no unusual activity during lunch, everybody would then go down to the trading floor in the afternoon session. And mind you, this was a pattern prevalent through the 80s and the first half of the 90s. And then it was really 1998-99 where we started to get more electronic trading platforms and this type of stuff. And then gradually those pits faded off into the sunset. So here was a day that was a much lighter trading range day. Characteristics of the lighter volume, I should say lighter volume, is that very often you have pronounced test reject sequence. So test reject after the 7 a.m. reading, and I guarantee that this was due to economic data being released. Statistically wise, it's never the actual data that comes out, it's the market's reaction to the data. So this caused an initial knee-jerk reaction, creating opportunity. Now that's another thing that traders from the floor learn quickly, is the savvy of being mindful of fading those news spikes, and you're not trying to buy on the flushes down. What we want to see is that price stopped going down. You've got 2 data points here, and perhaps as it starts to come back up, you're crying BS on that news data there. You see, it doesn't really matter what the news is. It's always the market's reaction to the news. And the second thing is just these tape bombs. For example, all of you are familiar with the quote proverbial tape bombs when Trump was in office and some bizarro thing was released, and the market could have these knee-jerk reactions very sharply. Same thing with the release of FOMC data. All kinds of things can be these one-off events in the market that cause these sharp movements, but there's really not necessarily follow through. And so the problem with this, if you're a chart person looking to trade off of indicators, I want you to look at the bottom of this chart. And I put up a 310 oscillator, which is really smooth and symmetrical and easy to read on 5 minutes when there's good volume. But look what happens. You have all these little wiggles and jiggles in this oscillator, which tells you that this is just pure noise. So if you like looking at oscillators and swings, make sure you're doing it in that heavier volume period of trading. Otherwise, the market is going to test, reject, test, and here you're testing the high, and here we're testing these swing lows, and that's going to be your main driver. These levels, always looking at these previous highs and lows. So those are super important for me. That's where the opportunity is. Are we getting continuation or are we getting reversals? Now, with the equity markets, Perry Kaufman's work suggests that they are the noisiest markets. So that simply means that they are mature. We have the most amount of market participants, from hedge funds to institutions to mutual funds to speculators to the smallest retail. All of this is what creates very noisy data. If you wanted to be a pure trend follower and capture the cleanest trends, you'd be best off to go trade something like rubber, okay, which doesn't have this broad swath of market participants on all different time frames. So we're really fortunate with these S&Ps and these index futures in general, in that they're probably one of the very few markets that offers more intraday trade opportunity. That is called the length of the line. So picture this. Picture the swing up, the swing down, the swing up, the swing down. And if I could take that as a string and stretch it out, it's going to have a much longer length of the string than would, say, for example, a 5-minute chart of the bonds or a 5-minute chart of the grains and so forth. And the currencies have periods where they are super trendy and it is a dog pile in or a dog pile out. And then they can be super noisy in this congestion. So they have the most extreme alternation of these states. So I'm just drawing your attention to the fact that just because we get our gorgeous little 9 a.m. inflection point, it doesn't necessarily have to lead to a straight trend in the opposite direction. And I thought it was very appropriate that Stuart, when he was talked about the times where we can trail a stop versus the times that you can play for a smaller target. So a lot of times when I'm trading and we don't have the volumes and the trendiness that would suggest trailing a stop, I'm always watching that action as a reference to that previous 5-minute opening bar. So this sets the tone for that. So if I'm shorting up here somewhere, I'm asking myself, can we get down into that first 5-minute bar? And when we rally back up and then we start to come down again, I'm asking myself, can we get back down to the opening price? And if we take out the low of that 5-minute bar, what's going to happen? So you see the questions I'm asking of myself. They have nothing to do with, is the oscillator hooking up or down? Is there a buy or sell divergence? These kinds of questions particularly lend themselves to doing modeling in that marketplace. What happens if we break out above the high or low of that first 15-minute bar? Of course, 50% of the time you get continuation, 50% of the time it'll lead to a test reject. But these are the types of questions that if you continually ask that will further your education in the market, as opposed to studying specific strategies with the Bollinger Bands or oscillators or this type of functionality. Another type of question that can be answered without the advent of technical indicators is with the volatility breakout systems. What happens if we get that range expansion functionality? Okay, so then what are the odds of follow through? So you see how we can start to build these models in our head. That was one of the things that made Toby Craybell successful, looking at what happens when we get range expansion off the opening price. Larry Williams came up with a lot of models asking what happens when we get range expansion on certain days of the week. And conversely, I have a good friend, Bob Duran, who trades stocks, specifically looking at this range expansion functionality. Again, free of all the indicators. Okay, so moving on, it is true that each market does have its individual nuances. So I would bet that the majority of you probably don't care about the small cap indices, even though it's the broadest display of market participation. And if you do look at market internals for the US session, you will see that that's greatly going to distort the market breadth readings or things like the ticks, which once upon a time had a lot of value, nowadays not so much. So some things do change with the market, but look at this ridiculous 5-minute bar on the Russell. So I don't bother with this index for the first 30 minutes. Remember how I started this talk. We are creatures of habit. There are recognizable patterns that repeat themselves. Well, the pattern with the small cap indices is that most of the large mutual funds, and especially the ones that use ETFs, do not execute or initiate entries in the small caps in that first 30 minutes of trading. And the reason is because the markets are thinner, they get screwed if there's an opening bulge, and so they'll be more likely to wait until after that first hour has passed or the afternoon session. So a lot of times we'll see the early plays in the hot to trot momentum stocks like the Zoom and the Netflix and the technology stocks in that first morning session, and then it'll rotate a little bit. Those stocks will stand aside and the small caps can come in. So there's lots of subtle nuances that we learn every day we're sitting in front of our screens. And for years, and I still do, keep a notebook of all the little observations that I make and things that I see. And they say that when you write things down, it goes to a different part of your brain and you remember it. So I'm always taking notes and writing down everything I see, even though I don't ever go back and look at those notebooks. It's just part of my process. So moving on, let's look at a real nice type of perfect pattern here. And here's our 7 o'clock reading. That's 8 o'clock Eastern time. You guys are just going into lunch over in Europe or getting ready to go into lunch in Europe. And so you see that we are right at the previous day's high. Very important point. And I just wanted to point out, here is our US opening, a little bit well below that high, well below the Globex high, which, as you guys know, is another visible chart point, the overnight range. Extremely important. So here we have our open, not much happening, a little bit of a test reject, 9 o'clock, and boom, bingo, you've got your trend up, the sweet spot in our data here until the blue dots signal Europe close. Okay, that's 11:30 Eastern time, just in general there. And I wanted just to show that whether you are using a stochastic or a moving oscillator, when there is better volume and trendiness, they can certainly have value, especially for marking the end of the swings. So what I like to look for, I know I'm talking a lot and I hope you're all taking notes, but you'll have these slides to go back and review on your own. What I like to look for at the end of a swing is one of two things. I want to see the loss of momentum from a divergence or a little wedge, something along those types of nature, or I want to see that dramatic sharp test reject where we poke up through the Keltner channels. This blue line here is a Keltner channel, which is simply 2.5 ATRs, average true ranges, centered on both sides of the moving average. So yes, indicators can have value, of course. And right here was a choice exit area pushing up through that Keltner channel at the end of a swing. So these areas where we poke through these Keltner channels also offer opportunity, either test, reject, or exit spots. And it's as simple as that. And I love the fact that Stuart talked about using ATR for a trailing moving stop. That works extremely well. And I use that to highlight the red, green, red swings on all my charts, which simply shows pullbacks. If you go to my website, you'll see a host of free YouTube videos I've done. And if you see this red, green, red stuff on my bars, because I usually don't use candlesticks, this is for the purpose of you. All of that is that same volatility stop function that was originally put out there by Wells Wilder, who sadly passed the last year, but not before he gave a fabulous, before he was honored by IFTA. So his rules for putting out this average true range functionality, this 2.5 ATRs off of the opening price, or you can do it off of the close, or you can do it off the highs or lows, to me is a concept that is durable and robust and serves us. So this channel here is simply another average true range function. And personally, I prefer this to band the price action instead of a Bollinger Band function or standard deviation function. Now, check this out. Purple bars, 1 o'clock. That means there's 2 hours left to go to the session. Ding, ding, ding. You can see all the horses coming back into the starting gate and everybody's ready and raring to go. And sometimes it takes an extra half hour to get going. And the majority of time, the market resolves itself in the direction of the morning trend. I don't like making counter trend trades in this last hour and a half of trading. But with that said, if we do have a pattern where we start to reverse and come back down to the opening price, which the market shouldn't do in the afternoon, that is important. The market is always trying to tell us something. So once again, you see this is a time of day function. It's a way that the market is trading that is free from the indicators and oscillators and so forth and so forth. All of these things are conceptual models that we build upon every day we're in front of the marketplace. Moving on, let's just see how this works on some of the other markets. Here is the euro currency, pretty blatant, the 7 a.m. reading here, the previous day's high. Look how we goose up through that. You can drill down to a 30-second chart and see the influx of volumes that come in around previous highs or lows, especially on an intraday time frame. as well as on this broader yesterday's high, and that's algorithmic activity. We like the algos because they provide liquidity for us. God forbid we didn't have the algorithmic activity. Everybody thinks they're evil, but God bless them, because that allows for us to go and bang out size at the market without slippage, because there's a little algorithmic market maker back there behind the scenes. So we like algorithms. They're just basically doing what traders would do anyway. It's just that people take the patterns that traders see, and then they try to create some systematic, methodical structure to it. So look at this. Check this out. Our U.S. stock market opening, and boom, 9 o'clock inflection point, top of the hour. Not only that, we have our Keltner channel reversal signal at the top of that swing there, that 5-minute bar. So if you go on my website, I put out everything there for free, except our little trading service, which is going to end at the end of the year. But there's a whole video on this pattern. I think it's just, I can't even remember the name of it. But when we push up through the Keltner channel and we take out that low within 1 to 2 bars, there's an increased likelihood that it was a trap, a little bull trap there, that opening bulge where people chase and they get caught, paying the top of that swing. Now notice here, when we pushed outside the Keltner channel here, right, going through that previous day's high, we did not take out that low within the next 2 bars. You see? So these things can be quantified. Our sweet spot, though, on this euro currency, the sweet spot of the trend in that U.S. morning session, where we have Europe participants, U.S. participants, maybe some scraggler Asia participants. This is the most opportune time of the day. And dribble, 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 dribble on down until we start to go into our afternoon session and we get a little bit of trend reversal. Let's look at this now with the start of Europe session, and we'll just use the DAX as our proxy. My dear friend Mandy, who trades in Australia and is probably the most amazing coach that I have ever seen. She had the we had the pleasure of, she came over to the United States before coronavirus, and we traded together for a month in my office. And she always used to call this sexy DAXI. Okay, so the DAXI can be a very sexy trading vehicle. And I watch it pre-market to get a sense of the rhythm for trading these S&Ps. So here is Europe opening. Once again, check this out. The previous day's high here, most important levels for me. We open, and what happens? We sell down in that first 30 minutes, and there is no test reject. There is no bounce off this little reverse opening bulge type of thing. We never traded above the high of that first 5-minute bar. We hardly tested that opening. And so we would expect the continuation pattern. And we've got trend down, sort of an ABC in retrospect. And then we reverse and rally up into our orange dots, which are U.S. session starting here, 7 a.m. for me. I'm sitting here looking at, are there readable technical patterns? If you wanted to squint, or if you had way too much coffee, you could see a little bit of a 1, 2, 3 rhythm, which could be a wedge. Regardless, if you don't see it, it doesn't matter. You only need one recognizable trade a day. So we have our U.S. stock opening, and once again, what marks the inflection point? That 9 a.m. reading rallies straight up into Europe close. Ding, ding, ding. So that was a perfect one. Obviously, the days aren't always so perfect, but the point of the matter is trading is a numbers game. It's a probability thing. I know if I look for this inflection point, maybe 25% of the time only, I'll capture a big win. And that's that's going to pay. So it's really good risk reward. Maybe 25% of the time we form a little continuation pattern and fall out the downside. Maybe sometimes we just capture a partial win, and sometimes we have light volume noise days where not much is happening. Perhaps it's everybody waiting for the FOMC announcement. Now, if I'm so fortunate as to be long here on our inflection point, what are we looking at? Talking about targets here. The most visible swing high out there, the previous day's high. So just watch these things for yourself. I'm going to add one more subtle nugget here, and that is it's all nice and well when we can capture that long-term trend and those opportunities to stay positioned in a currency or the bonds or gold, say for at least 2 months of duration. You might only get 2 of those a year. You see, so with trading, 2 other questions we have to ask ourselves. What is the frequency of occurrence for the setup? And it's wonderful if we've been monitoring the weekly charts and we get this dynamic weekly technical pattern that tends to be the driver for trends. So you go back and look at any period in history where we have a pronounced 2 to 3 month trend in the indices, in the gold, in the currencies, in the credit markets, and you will see that the driver is really the weekly technicals. So we don't get many of those a year. Our frequency of occurrence is very low. However, this time frame, which will jump out to of the 120-minute, 240-minute, is really solid. So we'll look at these 5-minute inflection points, these time of day inflection points, also within the context of those intraday time frames. Now, what you will notice with dividing this day up into 3 sessions, primarily Asia trading, Europe trading, and then I kind of divide it up into US morning and US afternoon, is that it's really rare that we get 3 back-to-back degrees of trend in the sessions. For example, in this case here, you can see that these green dots here were Asia opening. Okay, so this is a gold chart. I made it 15 minutes of data so I could squish everything up for you. So I've got Asia opening, trend, Europe opening, trend, and now our little 7 a.m. reading. And if I were so fortunate to be long from that Asia opening, which is in truth my favorite time to trade, capturing if I have a daily condition that shows perhaps we've been 2 days high to low, and as Taylor would say, let's look for that day low to high, that opportunity is going to unfold in that Asia session. So if we're so fortunate as to capture something like this, I'm looking to exit in that early US morning session, often right at 7 a.m. when I sit down. So another thing that you can assess, if you are starting in Asia session, what was the US session preceding it? If you are starting in Europe session, what was the US session and that Asia session? So if US had been trend down and Asia's trend down, it's highly unlikely that Europe is going to be trend down. Europe might be a counter trend trade. So you can see how perfectly this played out with the gold trend up, our little inflection point here, just the 8 o'clock opening, 8:30 opening rather, with the stocks. And here there was not a strong inflection point at the top of the hour. Instead, we just formed a breakout coil here. That was another little pattern, just a little bit of a triangle there on that 5-minute charts. Before then, taking out the low of that early range and having a trend down into Europe close and then into the noon hour time frame. You see, everybody goes to lunch now. And then when we start our afternoon session, it's like a new segment. Very often we can get a trend in the opposite direction or a counter trend reaction or reversal. So this is the spot that I don't like to look for reversals. Once the trend starts to assert itself, which may or may not be in the direction of the morning trend, I don't like to fade that last hour of the day. Let's just see how this looked on some stocks because they have their own little personality. And I hope it's certainly okay, Mr. Boris, if I'm just running over a tad here. I might have had too much coffee this morning.
No. You keep going
Alrighty, so
as you want.
how many of you trade equity options? I'll tell you, we have quite a proliferation of new traders in our market who trade equity options, perhaps financed a little bit in part with some excess stimulus checks provided by our government here. And these little equity options have become quite the hot to trot vehicles. They're like little hot potatoes, you know, and especially the Robinhood crowd that likes to trade the some of these meme stocks, as we'll call them. So often we see, and this is particularly pertinent with these big cap blue chips, look at this Google, this 5-minute bar, open, drive right into that 9 a.m. reading. It would be 10 o'clock Eastern time. Ding, ding, ding. This is a classic example of the opening bulge. And when we were in the trading pits, what would happen would be you see all the brokers coming in with these orders and they want to pay up for anything. They just have to own it and they tend to overpay. It's our job to sell to them. So it doesn't mean that we just are blindly selling. We have to run and scramble and buy stock to hedge ourselves. But that extra bit of implied volatility or premium and markup then tends to come out during the middle of the day. So be super careful if you trade options about not paying up during this time of day. And if you trade stocks and you are not in that first 5 minutes, let alone 15 minutes, mind your P's and Q's that you're not going to get this reversal at the top of that first 30 minutes because this happens so often in stocks. And of course, there's 1 out of every 10 that might be that hot potato that does keep on going. That's what people are playing for. But that is the exception. You see, not every goosing off the opening or gap and run, especially with these biotech stocks lately and some of these, oh my goodness, there's just, so many different hot potatoes out there right now. That's exactly what they are. You have visions of sugar plums as this is going to continue right up, but yet it can be the most significant time of the day. So just be careful about chasing. And I know you all know exactly what I mean. This is auction theory at its finest. They have to create volume, create activity in order to get you to chase. That's the market's job. So here was a slightly different inflection point. I just wanted to show a couple different examples. We have our opening, our test, and reject, and goose to the upside. But once again, it runs out of steam right into the Europe close time. So just another example with Apple there. Let me just summarize this so far, and then I'm just going to share 1 or 2 more tricks with you. Our classic technical analysis, of which I am a huge devotee. You guys know that. I love the technical societies. I love the Australian Technical Society. I love the International Federation of Technical Analysis. All of these organizations are near and dear to my heart. You can't go wrong studying the Schabacker and Edwards and McGee and these wisdom of these masters that was written 100 years ago, talking primarily about chart formations, the breakouts of chart formations, the ensuing trend that unfolds, and how support and resistance levels are formed. It's our basic Bible for having an initial foundation to trading. But as I have just showed you, that's not what real life trading is about. That just simply provides background structure, and it's very difficult to come up with a mechanical systematic trade that is going to back test out, looking at a large enough sample size, meaning at least 300 to 400 trades, and it's going to hold up into the future. You see, all of us want that little magic money machine, but it really takes understanding the conceptual side of the equation. You know, is there increase in volume? Where is the trend for the day? You know, these time of day functionalities, and in particular, the little bull and bear traps and the opportunity that comes from people overpaying at the tops of these bulges. All right, so we have our time of day functionality. The next thing I want to emphasize is just this concept of price levels. And I'm not one that uses Fibonacci or Gann levels or anything that is artificial, because I can't imagine Paul Tudor Jones or George Soros or some big fund player looking at Fibonacci. It just does not happen. With that said, it does have value to you if you're using it as a tape reading tool, because we all watch price relative to another price. So if you find value in it, watching price relative to a Fibonacci number, that's wonderful. I just can't get any statistical testing or modeling out of it. And, you know, I can't see it on my charts. I just have to be able to see the actual price. So everybody has different ways of going about things. The nice thing about looking at retracements, 50% retracement, all these different things, is it gives you a roadmap by which to anticipate. So I'm just going to show you a different way of looking at that. And I'm quickly going to summarize auction theory, because if you really want to build upon your foundation of classic technical analysis, study auction theory. And that doesn't mean that you have to have a market profile chart. And you'll see that the people that use market profile are very adept with it, but they have worked with it for years. I was introduced to market profile in 1991, 92, when I visited a broker's office up in New York. And honestly, I swear to God, for the next 10 years, I could not make heads or tails out of it. I liked my linear bar charts and my oscillators and my chart formations and so forth. But with that said, it is going to greatly enhance your conceptual model that you have going at all times. And that is, you are familiar with that concept of a failed auction, meaning at the top of the swing, volume does not come in, and you're left with that really quick little test reject tail at the top. I know everybody sees those. So those are failed auctions. A second concept is that high volume node. Just simply think middle of a trading range. And in a noisy trading range market, you will notice that the price wants to revert back to this comfort level, this home sweet home. But the thing that I'm going to present to you in this last bit of the presentation is this concept of single prints, these impulse bars, which happen in the direction of the prevailing trend, but it's spots where the market has moved too much too fast. It's this urgency to buy something without evaluating it. And then afterwards, we'll assess. Okay, so not much process goes into it. We just have this anxiousness of FOMO that we are going to miss out as well. So we have to jump on board. But these dog piles then have to be a leap and then look. Both the algorithms and the retail traders are active in these impulse bars, but they also leave areas where the market really did not stop to develop value. So I treat them like gaps in 1 degree here. So this is what the impulse bars look like. And the markets have a way of moving most of the time impulse, impulse, impulse. You can see almost 1 leg up and 2 leg up. I'm always looking for that ABC or that second leg up. Now notice here in this 240-minute chart of the euro currency, which of course had a big ginormous dislocation courtesy of the release of the FOMC data, which actually was a news catalyst for a very overcrowded trade. I don't think the news meant anything itself, but you know well, sure, that that dollar was probably one of the bigger short positions by funds, trend followers, macro players, etc., etc. So it was a very crowded trade. The FOMC, the Fed's news really meant nothing. It just meant that we had to have a vicious shakeout. But notice up here at the top, you see this bar here, this 240-minute bar. There's no price bar overlap here. So those are the spots that I mark off on my charts. Each day I have a separate page just for each market with these areas marked off, and they serve to me very much as swing highs and swing lows. They're like gaps. Is it going to be a breakaway gap, or are we going to fill the gap? And very often with gap theory, you know, the first look into a gap only trades about 50% of the gap. You see, so it's a nice conceptual model that works hand in glove with everything else. So we filled the gap or the single prints here to the downside. This created a ginormous location. It's probably going to take a lot of work for this market to heal before it can start to repair this anomaly here. And then we have this last little area here. And notice, just at the end of last week, what did we do? We had our ABC type of rhythm up off of that low, which occurred with the momentum divergence. So there is value to that, highlighting that. And we just poked up into that 50% level, plus or minus a little bit there. So a very key resistance area. The magnitude of this swing was so great to the downside, the market has not done that basing work to be able to fully repair that gap area. So that's one way of looking at it. Now let's look at the bonds, because this also was a very interesting period. I didn't, this was actually a week and a half ago, but you can see over here on the left side of the chart, we have a little bit of a hole, which notice how often the market just looks up above it and comes back down. Okay, all the people that were trapped up here said, oh, get me out, thank you, God, and then they got out. So this is a very visible structure by which we can quantify things. And you see the structure here. This served more or less as a breakaway gap, a launch, the impulse. This big bar, the magnitude of that bar tells me we had huge volume. I don't need to see the volume at the bottom of the chart. This was huge volume. So we have price highs and momentum highs, and that launched the breakout from that trading range. But as that range progressed, we had a little bit of a hole here, a little bit of a hole here, which was just repaired with this bit of test reject. You see how perfect that was, just test reject here. And then this last little markup, which still had to be traded through, tested back down. So you see this process of what the market is always doing. And once it starts to tip its hand, as this bar might have expanded down here, I simply go and reference, where does that market want to go? It wants to see, can it get into that hole to repair that hole? So that's just another fun way. It gives you something to study for your own going. This here was the S&Ps on a 240-minute time frame. Same thing, a little bit of a hole here. Just treat it as a gap, the undeveloped area here, and this is what is very prominent in the US markets for the last 5 years. I think it has to do with the amount of money just sloshing around out there. And this was the classic V formation, test reject. We had our close outside the Keltner channels and immediately took out the highs of these bars back inside the Keltner channels. So that creates the V shift in momentum, and you are not going to see that with momentum divergences, okay? So these are very much like traps. Just be aware of that, that your classic technical analysis may not give you the same type of clues as looking for and thinking about that V pattern here. On the daily charts, we had a wide range day to the downside, and then we took out the high of that wide range day within the next day. So very powerful signal that shifts all the momentum to the upside. And notice here, I just drew a little orange line at the top of that repair. You see, it has nothing to do with that swing high, nothing to do with the little low. It just has everything to do with these little bit of single prints that would show up on a market profile type of chart. Okay, I've just got two last charts for you. I put up the yen 240 minute because I know that we have a lot of currency traders here. And I put a blue line that's simply the middle of those ranges. So that's the flip side of you have your undeveloped single prints and you have your areas that could be middle of trading ranges or high volume nodes. And on this yen, a little bit of goosing to the downside. You see, we had our reversal taking out the Keltner channel highs there, high of the bars that were outside that Keltner channel. And we did it with impulse. We did it with a nice bar to the upside. And so we have this area to repair. And we did this A, B, C type of formation. So it's not always perfect or textbook. Arthur Scleroux, who wrote a wonderful book, technically oriented, always talked about seeing the market in terms of these waves, these ABCs. And sometimes they're more recognizable than other times. But when you see an ABC type of correction, that also provides superior risk reward. So we had a level up here where you had a little bit of a tail, great spot to put stop just above this area. And when we see an ABC in the direction of the prevailing trend, more often than not, it will make new lows. So we also had this little bit of repair down here, and voila. So far, we've looked at really interesting charts where we have impulse bars to the upside and the downside. We can see the merit of treating them the same way that we would as gaps. You can see the merit of this time frame, which is a little bit smoother in terms of our data as opposed to 5-minute data, which can be super noisy. And it lends itself to a trade which you can hold for anywhere from 1 to 2 to 3 days of duration. More often than not, 1.5 days to 2 days is ideal. So with that said, for all those people down under and talking about the magnificent trends where you want to trail a stop on the data, on the daily data, let me remind you again that that only happens really 2 times a year, maybe no more than that, maybe 3 times a year. So if we have a setup that has a frequency of occurrence of 4 times a year, and you can capture 50% of that, you're doing good. That would be 2 trend moves a year. If we have a pattern in the markets that's on 5-minute data in the S&Ps, for example, and the frequency of occurrence, say, for example, our 9 a.m. inflection point, well, you're going to have potential for 5 times a week, right? But you're doing good if you make an attempt at 2.5 of those times. So just like Stuart said, you don't have to capture every data point. You don't have to capture every signal. It's exhausting. We are far too hard on ourselves as traders. We are human. We have to set reasonable benchmarks by which we can trade. So if I see something and I can capture it 50% of the time, I am far ahead of the game. And the whole trick to trading, mind you, is not making unforced errors. It's not chasing where the trade location is disadvantageous. It's not making those unforced errors. The tennis players that can win Wimbledon or the French Open or the Australian Open tend to make much fewer unforced errors. It's a matter of keeping the ball in play, and then the market will gift you, 10 to 20% of the time a big win. So this Australian data here, this was just about a month and a half ago, and I've got a good solid 7 weeks of data here. And look at what a chop fest this was. But if you had a clue that there was going to be an inflection point or perhaps some type of directional bias, look how swank it is to play for these little areas of single prints where we need repair. Obviously, the market's getting goosed to the downside here because it took out this swing low. So you're hitting sell stops and you're getting an increase in algorithmic activity, but it doesn't follow through. And once again, we can play rinse, repeat over and over. The opening drive here, this is, of course, is not a 5-minute data, it's much bigger, but everybody now is dogpiling in because don't you know, we took out these swing highs and this could be the next major trend up for the year. I mean, I'm being sarcastic, of course, but you have to laugh at this, right? So this is where the volume comes in, and then your auction stops. We have the tail at the top, the contraction in the bars. That tells us that there's lighter volume. Okay, so you would probably have a perfect little volume divergence there. And then we have the failure test, the failure to make a full retest up. And this is what I call a U-turn to repair that overzealous markup period and then some. So you can play this game ad nauseum until you either figure out how to capitalize on it or at the very least not get suckered into it. And there is absolutely nothing wrong with initiating a breakout trade at this point. It would be perfectly logical because we're starting to break below this long sideways line, and there's good momentum to the downside. But then we came to a screeching halt, and that's why we do use risk management and so forth, all the way back up again. Okay, so just quickly to summarize, when you are trading, whatever time zone you are in, there are distinct time of day functionalities. Each market has its nuances. For example, Damon loves trading crude, going into the crude pit close, about the first, the 30-minute session before the old pit close on crude is actually the highest volume bar of the day if you model it out with 30-minute data, the exception of being the release of the crude report. But he almost always makes a trade in our trade room playing for that close, and he does it just looking at the holes in the market profile and some basic subtle nuances. So he'll always make a trade at that time of day in crude, and he loves to trade the last 30 minutes of the day in the indices. That's his confidence with that increase in volume and his comfort with those time of days. And he actually shows those trades on his screen when he's making them. So if you're in Europe, you can look at certain time of day functionalities. If you are in Australia, you can look at time of day functionalities. And same thing with Asia. Everybody, we're people of behavior, habits. We go to lunch at a certain time, we go to bed at a certain time, we do different things at the same time of day, but over and over and over again. So that's the same type of thing as the last couple days of the month and the first couple days of the new month. There's some bias there. Same thing with pre-holiday stuff. There's some bias there, and I don't think that these things are going to go away. And that's the whole trick, is finding an edge that is here to stay. So I have a lot of edge in watching this time of day functionality. Second of all, just be mindful about the levels. The previous day's high and low are very often reference points, especially if we open above or below them in the US pit session. And I would imagine the same thing to be true on Europe session and so forth. And then just some little subtle tips with the structural phenomena, the repair of these big bars here, as well as monitoring for that ABC. So I've just done a whole presentation for you, pretty much without the advent of any traditional classical technical analysis indicators, with the exception of commenting on that ATR function on the Keltner channels that could end a climax, be a little bit of reference point for you. And you see everything else starts to fall into place the longer that you are in front of a screen. Keep your notebook, jot down the things that you see, jot down your own observations. If you hear a tidbit from somebody else, write that down and go back and research that. Every day I'm making little notes to myself. See how this played out 2 or 3 days from now. Kyle is my assistant, and we always have 1 or 2 things that we made note of that we want to then see, how did this resolve itself 1 or 2 days from now? That walk forward type of thinking. You're not going to remember it at the end of the day, I promise you. There's so much that happens, but if you write it down, then you can say, oh, let me go back and see how this pattern played out. All very important for our learning process. I learn every day still after 40 years, and I still learn from other people. So it's all good and fun. I'll be learning till the day I die. If you want a chance to learn with me for the next 6 months, this is my little subtle pitch. I don't sell stuff and I don't have to do this. I basically retired from my hedge fund a number of years ago. But unfortunately, after spending so many years in the marketplace, I really don't know how to talk about anything else other than markets and technicals and share my passion with you. And the only other thing I can talk about is horses, but I guarantee that you guys probably do not have the same interest in that area. So I love nothing more than sharing my passion with you. And we're not going to be doing this anymore at the end of the year. Even if you can just join us for 2 hours a day, we're always posting, videos, research, doing little lectures that we tape for you. There's a good camaraderie. It's a lot of fun. I'm not in the business of doing education per se, but with that said, this is Damon's and my last hurrah, just to share everything I possibly can, because I don't want to take it with me to my grave. So there you go. You can go to the top of my tweet that Boris so kindly flashed at the beginning of this. There's also a link here, Linda and Damon Trade. If you go to my tweet, you'll see sort of why we're doing this or why we did it. And trust me, if I kept it up at this pace, I would be old and gray in the next 3 years and drooling in the corner, because we work super hard, but it's all to give to you. So with that said, my last little shameless self-promotion is this Trading Sardines book, which is only available off my website. Just to give you a heads up, there's probably only 500 copies left. I just did one printing. I'm not so sure I'm going to do another printing after that. If you are in Australia or overseas somewhere, understand that the shipping costs, I also subsidize that. So if the real shipping costs are $40, I'm paying $20 of that, because I figured I would rather subsidize the shipping costs than give the money to Amazon. So it's just a little bit of fun and humor there. With that said, I do have time for questions. It's I'm going to let Boris be the moderator there, and that's all at the discretion of how much time is left, since I ran a good half hour over.
I think I burnt through my whole notebook taking notes. on this presentation. There's so much to unpack, and I will tell you one thing, guys. As Linda was talking, I realized there's just so much to unpack there that I'm actually going to unpack it. I'm going to summarize some of her really key points when we post all of this, the video, the slides, the whole keepsake from the whole Trader Fest. I'm going to essentially bullet point what every single trader shared with us. And for Linda, it's probably going to take me about 30 bullet points just to digest everything she's given us, because just the daily, the business hours overlay against price action with the Keltner channels is gold. I mean, it's just gold. I just, while she was talking, just for fun, I overlaid the NASDAQ futures against, so Friday's trade against Thursday's low of the day. And guess what? Not once, not twice, not 3 times, not 4 times, but 6 times we tested the LOD from June 24th and bounced back and bounced back and bounced back. If you had that information in your fingertips, you'd just be minting money on Friday. This is really, really interesting and fascinating. There's just so many golden nuggets that she just gave away to you guys. We'll probably spend years unpacking it, which will be a lot of fun. So I just sent out the link to the Last Dance URL, which is their last 6 months of trading. It's really too bad. It's just because you're going to Florida, or you just like, that's it. I'm not gonna get any more.
Well, we didn't plan on doing this. It was sort of an impromptu type of thing with a little small group of traders that we had from this this workshop. So we didn't intentionally plan this, and but everybody was locked inside. It was particularly brutal if you were in some place like Manhattan and you couldn't go out. And so we had this captive audience, and it kind of became like a little family. So we just said, well, let's just formalize this a little bit, and we've got the Zoom and multiple screens, and I have the most wonderful assistant in the world, so it pays for his salary, and Damon and I have never had a chance to trade with each other, and I learned a lot from him and his views on auction theory and market profile. So it's just a journey.
It's so cool. It's so cool listening, by the way, that he trades a lot. It's funny because my whole presentation was, don't trade the last hour of the close in the S&Ps, because that's the craziest hour. It's always going to screw you. And it's funny because he actually trades the last half hour, because obviously he has got some domain expertise in how they really run the show there. So it's very funny. It's really interesting.
You have to understand that when he was an S&P broker, he did for a long period of time the execution for the RIDEX funds and some of these mutual funds, as well as some very large players. And so he would see the way that they stack their orders going into that last 30 minutes. And he has a pretty good idea of what they're going to do. So there you go, time of day and human behavior.
Yeah, that's super, super interesting. Absolutely. I'm trying to just kind of barrel through even some of the questions that they have. I mean, most of it is just, honestly, Linda, they just love you and they're just thanking you. There was I'm just seeing if there was anything unique or specific. I'll be honest with you, the whole gap presentation probably is going to take 3 or 4 watchings for people to begin to understand, because there's just so much there, both in fading those gap moves, as you said, kind of like that all those gap big candles get filled, will get repaired, as you said, get repaired and then come back out. But then I also noticed there's a couple of times, I don't know if you kind of thought about this, if the whole thing gets reversed, like you had a couple of charts there, like I think it was it Aussie? I'm trying to remember. Was like one of the last charts where you had like a huge flush to the downside. Yeah, it was Aussie.
Yeah, that was the Aussie.
Yeah, huge flush to the downside, and then literally that gap, it doesn't get repaired. It gets destroyed. It gets like eviscerated to the upside now. Like you see that last box, that black box gets completely covered.
That's a V spike. It shifts all the momentum to the upside.
Yeah. And I'm like, wow, that's a really interesting possible buy with a relatively reasonable risk control move. So like you can look at it both ways. It really opens up your eyes to kind of, I've always looked at it. I used to call those power candles, those huge candles, but I never could make sense of, how to actually trade them, because whenever you follow them, you always get killed, right? You always get killed. They almost always die out, right? Like almost all the move happens with the candle. But then, trading them sort of on a repair basis makes really a lot of sense once you see them as a gap, not just as a candle. Really interesting. Really interesting. Can you explain the offer one more time, please? Okay, just if you don't mind, if you could explain the offer. I believe it's just 6 months, which is this is the final 6 months that Lynn and Damon are going to host the live room, and it's $1,600. It's a discount to the original price. And
Yeah,
it's
no,
just
if somebody wanted to do it for 1 month, they can. It's just sort of a basic type of traditional chat room format, but we present all our charts at night, all the homework. It starts first thing in the morning. I do my overview of the things that I'm looking for in the marketplace, or if they already unhappen, it's like, well, then we have to advance it forward, and we cover primarily the futures markets, but also some stocks and options. And Damon then does his preview of what to look for 6 basic markets using his market profile. And he also has software that shows the candle volume. So the really fat candles have volume, and so he does that, and then ding ding ding, it opens, and throughout the whole day he and I take turns in either making trades or showing setups. Some we can show on the screen and trade ourselves. I'm always very transparent as opposed to what I'm doing. If I'm buying a stock or options, I'll just say I'm buying here, or I'm selling, I'm exiting, just very basic type of stuff. It's not meant to necessarily be, we'll call a specific trade. But with that said, I would bet that probably 80% of the people will take Damon's trades because they're short and sweet. They tend to last maybe 10 or 15 minutes in duration. So you could pay like $300 and just get a month. But we just said, well, we'll wrap it up into a special and discount it, because I don't want to have any discounted 6 months packages up there after July, because I'm not gonna do this after the end of the year. So it was like, okay, I think that over time you can present so much more information day by day and seeing the market conditions, as opposed to, I have done a weekend workshop before, and that's all fine and well. It's static. It's a different type of learning, which is good too, because it can lay a good foundation. But
Right.
I find that people then walk away from a weekend workshop and they forget a month later what the heck happened.
100%.
And it's really the power of seeing it unfold day
Right.
after day after day, real time, where
Right.
the actual learning takes place.
Right.
And and then we have some really talented traders in there. So a lot of times, people are looking at other people's, will post like, buying S&Ps here, or shorting the Nasdaq, or whatever they do. And I gotta say, they're pretty dang good. So it's just a nice little trading community for now. That's all it is.
That's great. This actually answers sort of the secondary question. A lot of people are asking, do you teach? I'm a newbie. Could you teach newbies? And I would say that the best advice I can give you with respect to Linda is, first of all, understand that the Chicago Mercantile Exchange and the CFDs now trade micro units, tiny little units, right? You can trade the S&P for 50 cents a tick. You can trade crude. Crude is coming out, which is amazing. Crude is going to be micro. So instead of $10 a tick, it's going to be $1 a tick, which means a whole dollar in crude is only going to be $100 to you. So my point is that if you're a newbie and this is bewildering and it's hard, the best way to learn anything is by doing. The best way to learn anything is by doing. And you could easily, join their room, trade very small on the CFD side too. If you're obviously non-US, you can trade CFDs. All of them provide micro units. You could even trade demo. Hell, I would trade demo for the first 2 weeks just to figure out what the hell's going on. But that's probably the best way to learn. It's really important. Nobody's going to take your hand and force feed you into everything. You're going to have to learn the concepts and the ideas, but by doing, you'll begin to absorb a lot of the key principal ideas that she's teaching here. So I think that's my best advice to you.
Yeah, trading is not complicated per se. I personally don't believe in these nonsense things like newer traders and master traders. I mean, it's just, we're all out there in the same sea of data trading, and the only difference is that it takes a bit of, you see what I'm doing? It's no complicated mathematical equations or anything like that. It's just
Yep.
a matter of building up experience, building screen time. And that's the part that people don't understand how long it takes. It really takes a
Right.
minimum of 3 years before you have seen bull markets, bear markets, outlier events, heavy volume, light volume, all these types of things, seasonal patterns. It really takes a minimum of 3 years. So it's like you're doing an internship or a residency, at a hospital, seeing a zillion MRIs or, a zillion different cases. It takes a long time to build that up. And so, it's the learning process is only what you see yourself. It's not necessary. You might get a little tip or, hey, here's the 5 minute look. Look, we're pushing outside the Keltner channel here. See this, so, drawing your attention so that you see these things on your own. And that's really the whole goal.
Right. One note, exactly. And it's exactly what you're saying. You're going to look at 1,000 MRIs before you even understand what it means as a attendee doctor. Same kind of a thing. It's all pattern recognition. We're all human beings. We're all basically hunting on the savannah. Nothing has changed in a million years. It's just different kind of hunts, and it takes lots and lots of practice to differentiate danger from opportunity. And that's really what it's all about. We're just looking for danger versus opportunity on the charts versus the savannah. And the best way to do it, I think, is just by literally doing it, by being around somebody who's seen it a lot and just kind of doing their own thing and follow them, and you'll see those patterns with her. So that's my big takeaway from all of this. There's one other question. The question to you, Linda, is do you have favorite instruments, and do you have instruments that you just sort of stay away from? Are you instrument agnostic, or do you favor certain instruments to trade? That's actually an interesting question.
So by instrument, I assume that you mean an indicator.
No. I think they actually, what she's actually referring to is like S&Ps versus Euro versus rubber versus like just sort of like, is there a particular?
I'm the requirements for me are liquidity, number one. So, the old saying, I put this in my Trading Sardines book, it's never a problem getting into a market. It's always a problem getting out when you want to get out. Okay. You want to have the liquidity there. And for that very reason, I've really refrained from getting involved with the crypto markets, even though they lend themselves at times to being technically nice. They're new markets. We've seen Chinese servers go down. There's, that we've seen pockets of illiquidity, and it's not worth it to me to trade a market where it's not scalable. So if I'm putting in the time and effort to do something, I don't necessarily want to do it on one lots. I want to know that I could do it on size if I chose to do it on size. So it has to have liquidity to get out, and it has to be scalable. And I don't find crypto to have either of those requirements.
It's interesting
So
you said
it's
that
kind
about
of like,
crypto.
we'll see what holds and doesn't. But I love the S&Ps. I love the bonds. I adore the boons. The boons, to me, are the most technically perfect market in the world. They have a tight spread between the bid ask. There's all the volume in the world. I just adore the boons. And there's periods where the currencies can be killer too. The euro currency, the yen, the Aussie and the Canada. I don't do the crosses. I just do the straight, dollar yen or dollar, against the dollar, because I trade the CME futures.
Right.
So,
right.
which is 99% correlated with the spot, but that's
Correct.
my vehicle. So, and I love trading the metals. I love trading copper and gold and silver, even though silver is an evil market. I love trading crude oil and nat gas, and sometimes the grains, So that's my wheelhouse.
Right. It's interesting, just sort of a side note on crypto. It's funny you say that, because this week, I follow, of course, a lot of crypto feeds just because I'm learning about the market. They were talking about the fact that the whale, the whale players in the market, the ones that really do like 1 or 2 or 3 or more than one Bitcoin, because that's a large size, has dropped off by like 80, 90%. So talk about, you really sensed it correctly. The volume just evaporated. Even if price is sort of hanging around, the volume itself in crypto is really evaporating now, which is a dangerous condition for the market.
There's so much opportunity and just lovely trading markets out there. Why do I want to deal with a can of worms?
Exactly. Let me see if there's any final questions, because we went over time, but it's been really so great. What is the name of the indicator on MT4? You can do Keltner channels on MT4. By the way, one just golden takeaway from all of this, God, is that a golden takeaway, was the Keltner channels with a 2.5 ATR as a substitute or replacement of Bollinger Bands. Really, really interesting. And you know, Linda didn't touch on this because she just didn't have time. But the point being is that the ATRs are much more dynamic and much more organic to the price action, because they are intrinsic to the price action that's moving. So that band is going to be sort of more accurate about the extremes than the Bollinger Bands will be, which is just a square root. I don't want to get into the math of it, but that's a really, really interesting takeaway to use that. So I recommend you guys all do it.
I don't know if I'm still showing my screen or not, but I just put
that's right. I took it away because I'm showcasing your
okay.
last
I
dance.
just put up the parameters. It's an exponential moving average, a 20-period exponential moving average with, 2.6%, ATR on both sides.
Yeah, so 20 EMA against a 2.6, sides. Okay. And by the way, Daniel, who was the programmer here that I saw you guys yesterday, there's a lot of stuff that Linda did, which is relatively simple stuff, like she color coded the 5-minute bars and stuff like that we can definitely replicate in TradingView. TradingView is the platform that almost everybody in this Trader Fest is using. It's a default retail platform these days. That we can replicate all that, so we can create a lot of.
You can do all this on TradingView.
Yeah, and we can replicate it in a beautiful way. It's an elegant platform. It'll make it a lot easier for you guys to follow some of the ideas that she had basically shared with us today. So that's it. I think I'm done. We did 12 hours this weekend. Unbelievable, guys. I want to thank Linda for the perfect close to this great Trader Fest. Been a great labor of love for me. Thank you so much. I will. Of course, we're gonna cut the videos, get everything done, send everybody all the links. Linda's going to share the PowerPoint with me, I hope, so that if you make it into a PDF, or she'll just send me the PDF of it, which would be great, and we'll put all that into a Dropbox. And again, Ms. Rashke, thank you so much. You've been more than kind and really went above the duty to share all this with us. And everybody go to her room, because it's a great last bargain left. So thank you again. Have a wonderful weekend. And I'll see everybody later. Thank you, Linda. Bye-bye.
Thank you, Boris.